So we don't like using it. Our coaches don't like using the RIPA calculation, because although it's compliant with tax, it doesn't tell the builder or the coach exactly what's happening in that building company on a month-to-month basis. So we always use the WIPA calculation, which in a lot of people's view, that isn't compliant with tax legislation. However, the truth is, most of the tax inspectors and the licensing authorities, they haven't got a clue about work in progress in the first place. So the chances of these guys figuring out that anything isn't compliant is probably quite rare. But don't take that as tax advice, please ignore that. But yeah, if you're looking for accurate information of a building company, you've got to be using the work in progress accounting adjustment, but your accountant may use a slightly different calculation for tax purposes at the end of the year. So basically, what I'm saying to you guys is management accounting is all about an accurate reflection of what's going on in your building company. This is information as owner of the building company that you need to be receiving each month and absorbing and understanding. And then, of course, your tax accounts are what keeps you compliant, and that really isn't your problem. That is your accountant's problem. I mean, you got to be looking at the right information, but leave your accountant to do the compliance stuff. This is what we pay these guys for, so let them do that. Now, in terms of just a few tips that I would like to share with you guys, is that if you are heavily reliant on your accountant or your CFO, maybe even your bookkeeper, I always like to, I think bookkeepers should really come under the umbrella of the building company, the director, however that organization is structured, and they should be producing the information in accordance to how the owner, the director of the business, needs to look at that information, rather than taking direction from the accountant. But I also understand that a lot of people might have engaged an accountant as a bookkeeping arm, in which case they're going to be kind of falling in line with what the accountant tells them to do. But the problem is, if you're looking at the financial reports each month that do not accurately reflect what's happening in your building company, then the decision making that you're going to be making is not going to be correct, and it can hold you back considerably, or it can lead you into a path of false security, where you think you're actually doing a lot better than you really are, and you start making some pretty bad decisions, and which eat up cash flow, and then it bites you hard when it all comes to roost. And that's what we see with building companies over the years. It's why we see building companies going down owing millions and millions of dollars, where you look at the financial history and allegedly they were making a profit for the last 5 years, and all of a sudden they lost, $3, $4, $5, $6 million. It doesn't add up, and it's all to do with the way their accounts are being handled and not reflected accurately. Another thing to consider as well is, like a simple one is like subscriptions. So if you're signing up to a subscription, you can pay monthly and get X price, or you can pay annually and get a discount. Now, the tax efficient way to do that would be to sign up all your subscriptions at the end of the financial year, and this is what we do as well. And that is a very tax efficient strategy, because all that expense is offset against tax. However, that's not a great reflection of what is happening in the building company for that particular month. So this is why it's good to spread the cost out over a year, so you get accurate expense reporting. However, from a tax perspective, that's not always the smartest thing to do. And this is the difference between management reporting and tax reporting. Another one is owner's salary as well. So a lot of builders won't put through a market salary. That's a big, big mistake, by the way. Yeah, you've got to be putting through a market salary each month. But a lot of builders won't do it because they've been convinced by their accountant to just draw on a director's loan at the end of the year. They'll sort it out tax efficiently, which, is great. There's nothing wrong with that. And you don't necessarily have to draw down a market salary through payroll, especially if you're in a position where maybe your business can't afford to pay you a market wage. But the one thing you really do need to do, regardless as to whether your building company can afford it or not, you need to be doing a journal into your accounts each month to reflect what is a market wage or a market salary for the role that you're performing. Now, as a rough indication, if you're not sure where that sits, you can look at the job market. Might find it quite hard, based on the size of your building company. But a very rough rule of thumb is your annual revenue times 5%. That's a rough indication. So if you're running a building company that does, say, $5 million a year in annual revenue, you should be looking at $250,000 a year salary. And when you think about it, with all the work you do as the owner, how much would it cost to get someone in to do that role? That's pretty much what it's going to cost you. If it's a smaller building company, say $3 million, you're looking at about 150. $10 million building company, you're looking at $500,000. These are the kind of numbers you've got to get into your fixed expenses on a monthly basis. And if you can't, or to be honest, if you are running a $10 million building company, you probably don't want to set up a salary for that amount, because there's more tax efficient ways of doing that. You can still pull on a $500,000 salary, but you might divert some of it into like a what we call a bucket company, or an investment company to optimize for tax, because you don't need to be spending all that money. But regardless of what you do, you need to have that figure inside your fixed expenses, and that can be as simple as doing a journal entry. So maybe if you're if you're running a $5 million building company, and your salary should be in the region of $250,000 a year, roughly, what's that, like $20,000 a month, $21,000 a month. Even if you were doing it as a director's loan, a loan isn't going to appear in your fixed expenses. So you want a journal to appear, which can then be fixed up at year end, but at least your fixed expenses are now going to be accurate, which means your profit and loss report, where you've got your income, then you've got your cost of sales, then you've got your fixed expenses. When you look at that each month on month, that is then going to be accurate. So that's a real big one, really important to get that in there. And of course, another one that I've already touched on is your work in progress accounting adjustment. The WIPRA, the revenue adjusted, which is tax compliant in some countries, then that is the one your accountant will use at year end. But you don't need to worry about that. As a builder, you are more interested in month on month accuracy, and for that you need to use the work in progress accounting adjustment. Unless you are putting that into your accounts each month, it doesn't matter if you're running tax accounts or management accounts, they're not going to be accurate. You're going to look at your profit and loss. One month your profit's going to be huge, very nice. The next month you can make a loss. Doesn't make any sense. So what do? We then tend to ignore it because it makes no sense, and then we simply look at the cash in the bank. Very, very dangerous situation to get into. You've got to be looking at your profit and loss and your balance sheet on a month by month basis. So to make that reflective of what's going on in the business and accurate, you've got to do that work in progress calculation each month and put it in as a journal. What you'll see there, doesn't matter if your revenue goes up and down each month. Maybe it's $1 million one month and it's like $250,000 next month. Doesn't matter. The profit percentage, you won't really move that much at all, and it will be a reflection of the gross profit you are actually making in your building company. So really, really important. The other thing I share with you is you need to zoom out a little when you're looking at numbers, and you've really got to be making strategic decisions based on quarterly results rather than monthly results, because the space in between drinks for a building company with the stage claims can be a little bit irregular, and some stage claims are up and others are down, and that can distort the months. And particularly, once we start getting into the end of year, December, January, even over Easter, these months can impact the revenue considerably. So you don't want to be making decisions on those and even trying to compare them to the previous year, because Easter obviously moves around, bounces around in between March and April. So that can have a big effect. So we really want to be looking at quarters to spot trends. And things tend to balance out a lot more in the quarters. So in terms of that, always like zoom out a little bit and look at the quarter. Still look at the month, of course, but look at the quarter, compare it to the previous quarter, compare it to the same quarter last year, and compare it, of course, to your target as well. All important stuff. But another thing, and this is especially important in relation to the work in progress calculation, but also really everything you're doing, when you do get to the end of the month and you've kind of finalized your account, which really you should be looking to do that within 5 days, I would say, of the month ending. So we're on the 2nd of August today. So really by Monday, you want to be locking down finalizing your accounts. And for that, you don't need to have all the invoices in from the previous month. That's a myth. Don't get hung up on that at all. You can finalize your accounts for July, on Monday, regardless as to whether all the invoices are coming in or not. But when you do that, you've got to lock your accounts as well, so that no one, like your bookkeeper, any of your admin staff, nothing gets added into the previous month once you've made this work in progress calculation, because the calculation is a snapshot in time. It's a moment in time. And if you were to do it on Monday, for instance, and then an invoice comes in on Tuesday that's dated July, and I think, I'll put that in the accounts for July. Well, you've just messed up all your accounts for July, and that work in progress calculation is no longer correct, which means your accounts aren't correct. So you lock it down, and that means even though an invoice comes in that's dated July, it still goes on the 1st of August, because the calculation you did on Monday, that was based on the work that had been done that hadn't been invoiced yet. So without actually kind of mapping it out and showing you, it might sound a little complicated, but really when you follow the template for calculating work in progress, it's very, very simple. But quick tick there. Always lock down when you do your month end accounts, always lock down the system date in your accounts package, whether it's QuickBooks or Xero, they all have it. They all have a system lock date. So find that, lock it down so that no one can add things to previous month. And again, I touched on it earlier, but better information leads to better decisions. It's so true. It's so important. So don't rely on cash flow as an indication of how well you're doing, especially those of you doing new construction. New construction is cash flow positive. So if you look at your bank balance is going to go up the more work you take on. It can be like a Ponzi scheme. So if you simply look at that, you're going to get a full sense of security. And it can be quite frightening when you actually find out the truth, because you might have $300,000-400,000 in the bank. Doesn't mean you're making money. You can still be losing money. A building company that's turning over, say, $6 million a year will probably generate around about $400,000 to $500,000 in positive cash flow at any moment in time. So, just because you got $500,000 in the bank doesn't mean you're profitable. It just means your sales are growing. So be very, very careful on that. And don't rely on your accountant to tell you how well you're doing either. I mean, your accountant may be good. I hear about a lot of fantastic accountants, but unless they've been specifically trained in construction financials, they won't even realize what they don't know. And that's because of the terminology that we use in this industry. It actually confuses accountants. The work in progress, calculation, for instance, that means something different to the way accountants have been trained. It's a very different calculation in manufacturing. And, you'll see even if you use zero, for instance, if you look under the nominals for work in progress, it will tell you that it's an asset. It's always an asset, and it's not in construction. Construction is very unique, and you need to be trained in construction financials to understand how to produce accurate financials for a construction company. Doesn't mean your accountant can't do it, but they've got to be open-minded enough to see how these things are done so that they can produce your accounts accurately. But that's one reason why you shouldn't rely on your accountant for advice and make your decisions based on what your accountant's telling you. Because apart from anything else, even if they do produce accurate financials, they are looking at history, whereas we have to look forwards as business owners. So we have to plan the future, map it out, and make decisions based on the future rather than the past. I mean, past is a good indicator of how the future might pan out, but we don't want to be basing all our decision making on the past. And the other thing, of course, is if you don't do this stuff, because of what I've just said, you will end up overpaying your tax as well. I can't tell you how many times this has happened where we've taken on a builder as a coaching client and we've delved into their accounts. First of all, they're not doing as well as they thought they were. But secondly, what's compounded the problem is they thought they were doing better than they were because their accounts were overstating their profits. Now, what that actually meant was they paid tax on those profits as well. And they couldn't understand, like, why can't I afford to pay my tax bill? So if you've found yourself in a situation, or ever found yourself in a situation where you've got this massive tax bill and you can't afford to pay it, or it might even be a small tax bill that you can't afford to pay, and you're like, surely if I've made this amount of money, I should be able to pay my tax. Well, if that's ever happened to you, chances are your accounts aren't completely accurate, and you could be paying tax on profits that you never made. So, we've had clients come to us that have overpaid their taxes by hundreds of thousands of dollars, and you can get away with it to a certain degree because of the positive cash flow that new construction generates. So it kind of comes out of that, and it's a bit painful, but hey ho, the money's kind of there. But all of a sudden, when the money's not there, like, you can't figure out what's gone wrong. So really, really important to get this stuff accurate. Otherwise, you'll just destroy your building company, and it won't happen overnight. It will happen over a period of 3 to 5 years, and it's it's so slow that you don't notice it and you can't figure out what's going wrong. But the bottom line is your accounts should always accurately reflect what is going on in your building company right now, regardless as to the legal requirements. You need to act on accurate financial information rather than be overly concerned about what your accountant needs to produce for the tax man. That's their problem. They'll optimize you for tax. That's fantastic. Make your decisions based on what is really going on. Let your accountant worry about all the compliance. So hopefully that has been of use to you. I don't think we have any questions coming in, but feel free to add a comment below if you do have a question. We're more than happy to tag an answer on. Another thing we are going to put in the comments for you is a link to a guide that we've produced on how you can calculate your work in progress accounting adjustment. Now, the bottom line is it doesn't matter if you're producing management accounts or tax accounts. If you do not do this calculation each month, your information is going to be all over the place. Anyway, you've got to do this WIPA calculation every single month. Get your bookkeeper to do the journals to implement it into your accounts. Lock down the system date as well, because if you don't, your gross profit is just going to go up and down. It'll make no sense, and then you'll stop looking at those reports. You'll look at the cash balance, and then you're going to be in real trouble. So better information leads to better decisions. Make better decisions, guys. It's a free download. We're going to put a link in the comments, so please download it, follow the step-by-step instructions, and start getting your accounts more and more accurate. So that's all for this week. I hope you found that of use. Have a fantastic weekend, guys.